Welcome to BYU's Tech Transfer Podcast. We are talking today about 5 big accounting issues that face tech transfer offices. This is Dave Brown, and I am here with David Campbell, who is our office controller at BYU Tech Transfer. David, you want to give your background just for a second?
Sure. I'm David Campbell. I've been here for about 3.5 years, doing the accounting and financial kind of strategy and tactical work here at the Tech Transfer office at BYU. Before that, I've spent most of my career in industry, corporate finance, and mostly in manufacturing. So did a stint at Intel, did a stint at Schweitzer Engineering Labs, did several consulting things, and so I'm here.
Yeah, and so David's real-world accounting experience has been really important to us. You might not think about tech transfer as an area where accounting is super important, but it actually is. A lot of what we do mimics what a corporation would have to do in their accounting department, and so it's been so nice to have that expertise here. So I have this list of 5 big accounting issues. Each of these is a big deal in tech transfer. If you work in the industry, you'll be familiar with them. If you're learning about tech transfer, this is part of what you need to learn because it's so essential to our operations. So David, the first topic is valuation of intellectual property. And I should say my background, I was a commercial bankruptcy attorney. I have an MBA in finance, so I've done a lot of valuation work. I'm not sure we spend a lot of time valuing our intellectual property. How much of that do we do, and why does it matter?
Well, it's hard to value intellectual property, first of all. I mean, part of the problem is from an accounting perspective that you can't, when you're creating intellectual property, you can't capitalize it, and therefore you can't depreciate it. And so you don't have a really easy way to aggregate all your expenses and all your revenue in one chunk of time. So,
and for non-accountants, why can't you capitalize it?
Well, the GAAP rules for, or the generally accepted accounting principles, which is often referred to as GAAP, they basically say that if you're inventing something, you're recognizing expenses as they happen. When you buy a technology, you are allowed to capitalize those costs. And that makes it easier for a company, for example, who licenses a technology or buys a technology. It makes it easier for them to recognize their revenue and their related expenses over time, which gets to the matching principle. That's also one of those generally accepted accounting principles.
A lot of people will assume that in tech transfer, when we're doing a deal, say you're selling a technology to a company, they'll say, well, how do you value the intellectual property? They assume that we're doing a valuation, but most of the time we aren't. Why don't we do more valuation in that situation?
Well, think of real estate. When you're trying to get a value for your home, you what do you look at? You look at maybe comps, right? Mm-hmm. And so we could look at comparables in the industry if there is any. Some things are so novel that there just really isn't anything comparable. But yeah, I mean, what do you have to judge against? You have sometimes if you work with a company and they say, oh yeah, we like your technology, this is going to be great, we've never seen anything like this. Well, there's your problem. They've never seen anything like this. And so what they're doing is they're assessing the potential revenues, the potential market size, the potential cost associated with those revenues, and the whole gamut of, if it's a manufacturable product, for example, they're going to go through all of the cost structure, direct and indirect, and try to figure out what their margins look like and what the future looks like for the product.
Right, and sometimes we avoid valuations here by doing deals that are structured so that you don't have to value. So if we're doing an equity deal or taking a royalty, we really don't have to know what the asset's worth. We just have to have a general opinion about how much of a business is attributable to the technology.
Yeah, it's almost like you're gauging the what you just said, plus the question of whether the management team is gung-ho and skilled and ready to take this to market. Mm-hmm. So you're assessing some qualities that are a bit difficult to put down on paper.
Mm-hmm. And then one final thought on that point is, when we're doing a deal, say this would be a less common deal, but we're selling an asset for a single lump sum payment to a major corporation, That can happen. That happens sometimes. In that situation, that's where valuation would seem most important for us. But it's still difficult to value IP and intellectual property. And so in a situation like that, we might look at comparable transactions. We might talk to the professor and say, what kind of deal would we have to do here to feel fair to you? There's some alternatives to actual asset valuation.
Yeah.
Okay, well, thanks for talking through that one. So that's issue number one that you run into. This next one is a little more challenging issue and one that I know you deal with a lot, revenue recognition. In tech transfer, what issues do you run into? And maybe explain what revenue recognition is.
There are rules to what you can recognize as revenue. If you're looking at a company's financial statements, they're going to look better if you have plenty of revenue and if you have plenty of assets. Well, you have to be careful what you allow people to recognize in terms of assets and in terms of revenue, because it's not necessarily a sure deal. For example, a balance sheet item that would be under assets would be receivables. Well, how sure are you that you're going to receive what's on your receivables? And you have to gauge credit risk and all that kind of stuff to be confident that you're going to get what you say you're going to get. So when you do that sort of snapshot in time financial statement, you're going to have to add some kind of confidence level, and that's part of the reason why they set up revenue recognition rules. A revenue recognition rule specifically is about whether you can actually say what revenue you expect to be paid, how likely that payment is to occur, and there's some other stuff that I don't remember, but that's the basics. It's sort of like saying, yeah, we know exactly how much we expect to be paid. For example, maybe you're getting a reimbursement, and so you know exactly what you spent and therefore what you should be reimbursed. But maybe what you don't know is whether the startup actually has the cash to pay it, or whether they're going to pay it short term or wait a long time to manage their own cash flow and pay it 10 years from now.
And this is an area where people will sometimes suggest naive solutions to tech transfer. Like people might say, well, why don't you just do transactions with more credit-worthy companies? Or why don't you collect more of the money up front? Then you know you'll receive it. How do you respond to those things?
Well, a tech transfer is a bit wild. I mean, you've got mature companies, definitely, who are interested in technologies, but you also have startups. And sometimes the startup is well-funded. They've already got something cooking. They already have been able to raise money. And sometimes they're so early stage that they haven't been able to raise money from a timing perspective, but they have high confidence. And sometimes it's a startup with, deer in the headlights questioning. Can we raise the money we need to raise? So it's not necessarily easy to figure that out. And it's also not easy to figure out where you're going to place a technology. In other words, if you get a technology in the door, you can't predict necessarily that technology is definitely going to an established company. Mm-hmm. So there's a lot at play here. One of the reasons why startups are sort of interesting is because they might have an edge that a developed, well-established company doesn't have. They're not capable necessarily of taking risks like a startup is willing to. And sometimes that pans out, and sometimes that doesn't pan out. And so you're really managing credit in terms of how you book reserves against your alleged revenue and that kind of thing. So you're just trying to be safe.
And in some ways, tech transfer offices act a little bit like venture capitalists. We're not investing, generally, at least in our office, we're not investing cash in startup companies. Instead, we're investing technology, which, to be fair, costs money to create. Mm-hmm. But we're investing in something of value in the startup company. And the dynamic is a little bit like for a venture capitalist. Even if most companies failed, we could still do really well because winners can do really well financially. And so my point is an individual transaction doesn't have to make complete financial sense. Like you can accrue receivables that have a low probability of being collectible, and yet the whole picture still makes sense.
Yeah. And the other thing is you have to be willing to realize that the risk-reward combination is sometimes difficult to determine long-term, but easier to determine short-term. And yet, in the short term, you wouldn't expect to have a huge reward. Mm-hmm. So sometimes we're willing to say, look, we just want a piece of your exit. We don't necessarily want anything big up front. We just need to cover our legal expenses, because we frequently will have legal expenses well before we have any revenue, and so, or reimbursement for that matter. And so we're just trying to be careful with the money we spend and careful to recoup that money as quickly as possible, and yet allow startups to do what startups have to do, which in part is manage cash. So there's a short-term, long-term game question that always has to go along with any kind of deal, and when and how you recognize the revenue.
There's also, so there's the short-term, long-term trade-off, and then one other wild card in the equation for tech transfer is the mission of your tech transfer office probably is not to maximize financial results. That's at some universities maybe it is that, but definitely a BYU tech transfer, getting technologies out in the world where they help people is a main driving force, and sometimes that's profitable, but sometimes it's not, and even when it's not, it's still worth doing.
Yeah, and some universities have policies that sort of, like for example, some universities might have a policy that says if you have equity, the moment you get the ability to sell that equity, you should sell it, regardless of what the price is or the value is of that stock. So that
and we know some universities do that. I've seen that.
Yeah, absolutely, and they're required to in some cases by policy. So, and some not. Some still have freedom to make the choice, but they're making choices to mitigate risk rather than to seek long-term gains. So it is an interesting circumstance to be in.
Okay, great. So that was revenue recognition. So kind of the other side of the coin would be expense recognition and cost allocation. What types of expenses do we have in tech transfer that you account for, and are there any quirky aspects of accounting for it?
Yeah, I mean, there are a few situations where different tech transfers will behave differently. For example, some might be more engaged in marketing and therefore aggregate or have marketing expenses. Most of our expenses at BYU are legal expenses, so we engage outside counsel to take care of patent prosecution work, and as they do that work, we get the expenses for those, we recognize them immediately, and we pay the law firms for that work. That doesn't necessarily mean we have a party engaged to license the technology yet, and may not for several years. But and so there you have that little model, first of all, that says, are you willing to take a risk that you will never recoup your expenses? And so you're making some judgments about the quality of the technology, the strength of its patent protection or the patent itself, and those things. Now, once you recognize those expenses, you have to figure out how you're going to get them reimbursed, or figure out when to stop them, which obviously means abandoning the patent prosecution effort. So that's one package of thinking. Cost allocation is an interesting term.
So let's see, where's a blurry area where you don't know what a cost is?
Well, I guess the thing is that sometimes especially some universities will have their research department or whatever office combined with their tech transfer office, and so they are passing through some money that comes into them, whereas others like us, our research office is separate, and so that lets us focus really on the patent side. But if you're having a combination, then what you're doing is you're spending money on your patent prosecution, and part of the deal might be that you have interest from a corporation or from some outside donor or something, and they're passing through research money through your office. Mm-hmm. In which case, you're obviously able to use some of the money from a license to reimburse patent prosecution costs, but some of the money, like in our case, we wouldn't hold any research money, so we don't have it to do anything with. So those, from a buyer's perspective or a corporate perspective, or licensee perspective, they know that when they engage us, that they probably are already interested in a technology we have, and that is partway through the patent prosecution effort. And so when they spend money, part of that money isn't necessarily just going to be royalty. It's going to be the reimbursement of those legal expenses.
Yeah, and so that's less of an issue for us than other universities because, like David's saying, we're tech transfer and the research administration office are separate here at BYU currently, but and always have been, I think. But if anyone was confused by any of that, so another function at a university is to manage sponsored research. Obviously, the federal government sponsors a lot of research at universities, and is I assume by far the largest sponsor of research in the United States. But corporations sponsor research also. So a corporation will give money to the university, overhead will be taken out of it, and then that money goes to a professor's lab where they do some agreed upon research program. For us, the way we interact at BYU with that is the research might produce patentable technologies or something that can be commercialized, and that's when we get involved. But at some universities, tech transfer would be doing the research agreement also. So our cost allocation issues are maybe a little simpler than some places.
Yeah.
But this next issue is one that's unavoidable for tech transfer, and that's contract negotiation and management. Here, I would be more on the contract negotiation side, but you go through all this work to negotiate a deal, launch a startup company, have something headed for the market. But once you've signed the agreement, you're not over. You're not done. There's an agreement to manage. What sorts of accounting issues come up in managing agreements?
Primarily, it's about timing, right? Because most agreements have elements where they're saying you've got to reimburse legal expenses and you've got to pay us some royalty. Now, to encourage a licensee to take the product, the technology that they've licensed to market, usually the agreements will have some kind of minimum royalty. And the idea is that if they get to market faster, then they're going to be able to cover that minimum royalty and probably pay you, in addition to that, some earned royalty. However, most startups and most even mature companies have limitations in terms of what they can spend or what they would budget for a specific effort. And because of that, they're going to manage cash. So from an accounting perspective, I'm always concerned about a couple things. One, primarily, is open communication. If they're open with me, it helps me understand their situation, and it helps me understand when and whether they're willing to take care of their obligations per the agreement. If they're totally open with me, it also makes me more willing to say, hey, I know you guys are struggling with cash. Maybe what we should do is try to make an amendment to the agreement so that it reflects the reality of your particular cash flow situation. And in that case, what we would consider doing is maybe negotiating, pushing out the minimum royalties. Maybe they haven't. Maybe they're in a trial, or they're. I guess I have to be careful about the word trial. Maybe they're testing the product and they haven't fully developed it, and they're spending so much cash on that they really can't afford to pay them in royalty. And you can see that they're doing a lot of diligent work to get to market, but they're just not quite there yet. And in those circumstances, you would want to renegotiate. But the accounting is, in that whole stage of the agreement, is all about having a good relationship, making sure you're pretty transparent, and making sure that the agreement that is the focus is really reflecting the reality of the company's circumstances, and particularly their cash flow circumstances.
Yeah, and sometimes it's hard to know when to take collection actions that are a little more aggressive. You can terminate a license if someone's out of compliance, but we want our companies to succeed. And especially if a company is a few years into commercializing a technology, if you end that, there's not necessarily immediately going to be someone else lined up and willing to invest all that effort into it. Some people in our industry will tell you that a technology can be a little tainted if it's been attempted by one company and failed. So there are lots of issues you think of, but on the other hand, when you enter into a contract, you need to hold your other party liable to it, or hold them to the standards at some level, and those can be really risky decisions. Any thoughts on when it actually makes sense to terminate an agreement?
If you sense that a company is unwilling to communicate, or if they've become difficult to work with, or just rude,
yeah,
then I think then you have some basis. But it rarely pays to do collections action in this case. What you really want to do is make them more responsible for what they're deciding regarding the patent portfolio. For example, you mentioned earlier that it can taint a technology. So if you have a licensee and then that license terminates, it might make other potential licensees go, oh, why did they terminate? But really that's a question about whether the technology is well developed enough. It isn't a question about why the company failed. And typically companies fail because of cash flow and because of just difficult management situations. Or just a poor management
being
team.
Undercapitalized, whatever, all these business reasons.
Absolutely.
Yeah.
The inability to raise funds or that kind of thing. So it's rarely fair to say that the technology is bad simply because a particular licensee didn't work out. On the other hand, like I said, most of the accounting situation for an agreement is really about credit management, and I realize that that credit management often results in collections actions, but I find that by creating a relationship and by trying to be transparent and open, and maybe if you have to play hardball, you can say, look, your agreement requires a quarterly report. Please take this opportunity to kind of share where you're at, not just your financial quarterly report, but also like how do you feel? Like where are you with the progress of the technology, and how is your business working? Because we can offer some I don't know what to call it, maybe business counseling that could maybe be helpful.
Yes, some of our companies have a great relationship with us. They keep us in the loop. We know where they're at on product development. Even if they're doing something complicated like getting FDA approval, we'll know how that's going, and that's really helpful. So I think the takeaway from your comments for a licensee company would be, if things aren't panning out financially, or you're not going to be able to fulfill an obligation in your agreement, reach out to the tech transfer office.
Absolutely, that is so important. Yeah, going silent is not helpful for anyone. But in terms of the collection technicality, you're going to get cents on the dollar if you send them to collections, and you're going to sour the relationship.
Oh yeah.
So it has some negativity that you don't really want, and maybe can't even afford.
Right. What we want is for our company to succeed, if at all possible, exit, then come license another technology and do it again.
Yep.
One thing we do to reduce risk here that other universities are maybe less able to do is that we often sell technologies outright as opposed to licensing. If you have federally funded technologies under the Bayh-Dole Act and regulations, you can't sell them outright unless you get agency approval from the federal agency. But a larger proportion of technologies here than at other universities are funded with non-federal dollars, it seems. And as a result, we don't have those strings attached, and so we're able to sell outright. If you sell something outright, it reduces the management burden because an assignment is just a simpler transaction. The other party is fronting patent costs, and so that makes things better. So I just want to note that one maybe oddity that really helps us out.
Yeah, actually, if you don't mind, let's spend a minute on that, because there are some really interesting advantages there. I mean, obviously, a tech transfer can work a deal with any of their licensees to pay the attorney fees directly. But an assignment really means that they own the asset. They can put that asset on their books, so it's literally an asset, And that has some potential advantages in terms of raising funds.
And acquisition, because when they're
Yeah.
acquired, most acquirers are not going to want to suddenly have a royalty to pay to a university.
Right.
So if the party owns it outright, that's better.
Yeah, exactly. And so having the freedom to make those assignments, which I think you said it before, but that's when the licensee actually isn't a licensee anymore. They actually own the technology. They buy it outright. And that's good for us because now we're not acting as like a short-term line of credit where we're paying the legal expenses and then asking the licensee to reimburse them. Mm-hmm. We don't like that necessarily because that puts us constantly in a mode of high administrative cost because we're constantly assessing the expenses, rolling them up into invoices, and sending those invoices out to the licensee. It probably is annoying to the licensee as well because they're having to spend time doing accounting when they want to do research or they want to do marketing. So there's some advantages to those assignments. And then the other thing is that assignment idea just brings to mind some of the other cool potential benefits of making a smart deal. If you're going to buy a technology and have it on your assets, maybe if you want to keep your books looking good and keep your ability to raise money, maybe you don't put equity in the deal. As a part of the deal. Maybe what you do is just say, let's do some exit.
Yeah, a percent of exit. So whatever the acquisition price is, you get your little percent of that.
Yeah.
And that's good. And just philosophically here, one thing we've done here that I think works well at BYU Tech Transfer is when we enter an agreement, it's not over. Like many agreements that you do will eventually need to be amended. So if you have an agreement that's not going great or that you don't love, just gradually amend that, make it better and better and more like the type of transaction you want.
Yeah, the agreement is it's a living thing.
Yeah.
And when you treat it as a living thing, it kind of fosters that open communication that you want in a relationship between a technology creator and a licensee. And so, I think that's optimal.
Okay, so we have a couple minutes left for the final issue, and we might not have a lot to say about it either. Issue number 5 is compliance and reporting. When I saw this, I'm thinking, well, that means the iEdison reporting, iEdison on federal funded technology. Is there anything else you would see as kind of compliance and reporting for us? Because I'm thinking we'll do a separate episode with our iEdison person where we'll hit those issues.
Yeah, I mean, I guess from a front off, or I don't know what to call this. Maybe the idea here is that you just need to be very up on your processes, because if you're not, it builds up a pretty big backlog, which can be costly to work through. So from a cost management perspective, it makes sense for tech transfer offices to be really on top of
You're talking about iEdison?
Things like iEdison, yeah.
Yeah, and I should clarify a little bit more. So if you have federally funded technologies that you're commercializing, you report to the federal government on the status of those technologies using the iEdison system. And so you're telling them, what do you tell them? If it's been patented, if it's been licensed, that you're retaining ownership, all these things.
Yeah.
You make elections.
Exactly. You're giving them the whole status of the tech, whether or not you want to continue trying to do patent prosecution on it, or maybe you even want to just send it back to them.
Yeah.
All that's reported on iEdison.
So that's what we'd really think of as this 5th issue, compliance and reporting. All kinds of complexities you don't think about if you haven't done it before, and one of them is accounting. It's these big 5 issues and some other issues too. So thanks, David, for helping us understand that.
Sure.
All right. We'll take care. We'll be back next week with another episode.